and welcome to Talking Technicals. Today we look at a very basic indicator which literally speaks volumes in technical analysis, no pun intended. So of course you've guessed I'm talking about the volume indicators, and our show expert Dr. Narayan will help us use these indicators to sift all the price action between trending markets and sideways markets. So what are trending markets, you ask? Basically they are markets that follow a steady trend, and that could be either up or down. So what about the rest of the time? And that's the more important question really. Like for instance, what our markets are doing at the moment. One step forward, two steps back, a lot of noise and confusion. So how in the world do you tune into a market like this? Doc?
Well, you see, most of the time the markets are, in a trended phase only about 20-30% of the time. The rest of the time they are actually into a non-trended phase. Now that is easier to say than to really, actually try and find out in the chart itself. So most of the time what we have are tools and indicators which measure the trend. So the non-trended phases, there is really nothing, there isn't really anything that we can measure the non-trended phase directly. It is actually an inferred kind of conclusion that when the trending parameters do not work, that is the time we look and say that, okay, if the trending parameters are not working, the market must actually be non-trending.
Right. So these are of course markets where you will see parameters like moving averages, moving average convergence, divergence, RSI, all of these sort of don't give any indicators. They kind of literally fall apart. So what are the warning signals for indicators not working, and how long does it take to establish a sideways trend? Let's see that on the chart, Doc.
Well, let me start off with showing you a chart of how a non-trended phase actually looks like, and what is one of the simplest things that we could do. Here I have on a daily chart of Sterling, which you can see has been, this is actually a pretty messy kind of chart. It's not really going anywhere. See the white line in the middle? That's actually the, it's a regression line. The regression line is a statistically derived trend line, which here in this case you can see that the slope of the regression line is almost flat, which means that there is really no trend. And around the regression line I've actually drawn two channels to indicate that the market is sort of completely held within a range. Now this is how very typically let's say a non-trended phase looks like, and we have to find ways and means of trying to deal with this.
And how do you make those channels?
These are what I've done here is I've taken a regression line and I've simply plotted two standard deviation channels up and down, and I've drawn them sort of parallel to the regression line. So I've added two standard deviation up and I've subtracted two standard deviation down to actually create a standard deviation channel around the prices, and you can see that it's almost flat slope, which is how typically it will be when the market is into a range.
Right. But let's get back to the mind of an actual trader when all of this is happening. So say you're a directional trader and suddenly that you see the market has switched from having a trend to basically sideways movement, and your first tendency is to really continue with what you're doing because it takes a while to figure out that the trend has stopped working and it's going into a sideways phase. So really, how quickly do you figure out what this market is, and what are the new tools that you would use actually to figure out and to play these sideways markets, Doc?
Well, we have a usual set of stuff, your RSI oscillators, but then when you come to a range-bound market,
those don't work, right?
Those don't really work because they also get into a sort of a range themselves, or they become very narrow, or they give frequent wrong signals. You're looking at, because all these aforesaid items are really trend-finding tools. So when the share is non-trended, it is sort of natural that it will not work. So at such times we need to bring in newer things which are specific to finding ranges. And for range finding, here I have on the chart what is known as a Bollinger Bands. See, the Bollinger Bands are volatility bands which are actually laid up on top of the prices, and they seek to hold the prices in in between two bands. And along with the Bollinger Bands, I also have another indicator down here which is the stochastic, which is actually a range oscillator. So when you're in a range, you need to find out something which will truly contain the range in terms of the prices, and also address the range situation in terms of an oscillator, so that we can combine them and take a trade.
Right, very quickly, let's explain to you what the Bollinger Bands are. You have a middle line in there, which is basically a moving average over a fixed period of time. Say you take a 20-day moving average, and on that, on the upside and on the downside, you make you take a line which is 2 standard deviations above and 2 standard deviations below. And standard deviation is, it's a term that for some people it might sound a little complicated, but really it's only a measure of how much the price is moving up and down about an average. So there's a statistical measure for it. It's very easy to calculate. You don't even need to know the formula for it, but you pick that, and that basically gives you the range in which about 80 to 90% of the time is when you expect prices to stay contained within that band. All right, so this is what we know about range-bound markets right now, but like we told you in the beginning of the show, it's daily volumes that can tell you a lot. They might not be the single most important indicator, but they are a very critical support indicator to either confirm or deny a trend, and they tell you a lot about price strength of a stock. So for instance, it will tell you the demand-supply dynamics. Dr. Narayan, if you see that there's for every higher price point for a stock, there are higher volumes to go with it, it obviously indicates a lot of strength. And similarly on the downside, if you're seeing big volumes and decline in prices, it suggests weakness. So what kind of patterns do you typically see on the charts for volumes?
See, when you're dealing with volumes, it's a little bit of a tricky situation, because volume is not a kind of a primary indicator, right? Volume is a kind of a secondary indicator, or it is actually used to confirm price moves. So while it is right to say theoretically that if you have an up move with a lot of volume, it will sustain, or a down move with reducing volume will actually fizzle out, in real-time practice it works a little bit differently. What we should be concerned about is increase in volume, because that clearly shows you, or it's a confirmed signal of whether the move will sustain or not. So we should be going more with increasing volumes, and with the lowered volumes are not so reliable as an indicator. So let me show you on this particular chart. I have a chart here of Punj Lloyd. This is at the time the Punj Lloyd results came out. This is a very recent chart. Now you are seeing that Punj Lloyd actually makes a bottom. Near about the bottom there is a lot of volumes here, right? These are the volume bars and the price bar. This is the first time when the stock actually made a bottom. It's on a high, fairly reasonably high sort of volume. Then it stages a small rally, and then it actually makes a lower low. At that stage you can see here that the volumes have actually petered out, fairly strongly. So as this particular selling happened, the volumes actually dropped off, showing that prices were losing ground, but there was not much of volume accompanying. So this is the classical picture of how the volumes will look. Now you will not see it in every case. You are seeing it in Punj Lloyd, so it's which is why I'm showing you this as an example.
And so what does it mean? So you've seen the volumes actually peter out. Does that mean
at the second newer bottom, it means that people are not ready to sell at lower prices. So this is actually something which is setting up for a reversal. Then you see the next part where the share prices actually went up. This is the day that the results of Punj Lloyd came out for the fourth quarter, and that actually took the market by surprise. And then you see the build up in volume. This is the rise in price. You've got a high top, high bottom here, and then you got substantially higher volume. So this says that Punj Lloyd is done with the decline, and now it is on a rising trend, which is also accompanied by volume. So this large volume gave us a signal that this rise will probably sustain.
Right, interesting. So you've seen how volumes behave and give indicators. Let's also combine this with resistance and support levels on a chart. So resistance basically acts as a temporary ceiling on the stock price, and support acts as a floor. And this is one way to draw a price range for the chart. So these levels can be used for drawing trend lines, or by using trend lines, or by using moving averages, or there are other pivot point methods as well. But we'll talk about those later. Point is, how do you combine support and resistance levels with volume action on a chart? Let's see that on one more, Doc.
Yeah, I had shown you the situation with respect to the uptrend. Now let me just take an example of a downtrend. What we have here is a chart of Bale, and you can see at the top, this is a little oldish chart. I'm trying to show you how the volume increases on the let's say the decline. Now in the earlier part, this was like a kind of a support zone where the market had repeatedly bounced. Then actually the support line breaks, and once it breaks, till that time Bale was doing all right. This was part of an uptrend, right? And if you had drawn a trend line from here, it would have actually, so okay, let's actually draw a trend line here. So if you had a trend line, it would be something which would actually come up like this, and this is where you have a break of a trend line. So this is a break of a support. So in and around that area, you find that the volumes are pretty low. But then once the support is gone and the downtrend actually starts, Now you see this area. This is an area where the volumes are actually increasing as we move to the lower level. Now this is something to be very wary of when very strong stocks, they are facing a trend on the downside and the volume pattern increases. This is an indication of an exit by long-term holders, and that is something which says that prices will keep moving lower in the future. So rising volumes, whether you're coming up from a bottom or you're coming off a top, breaking supports, in both the cases is very, very significant.
Right. So like we told you in the beginning, daily volumes tell a lot about price strength of a stock. It tells you about the demand-supply dynamics of the stock. So we've seen that with every price rise, if there are higher volumes, that indicates strength, and vice versa. If you have lower price points with high volumes, it indicates weakness. Also, institutional activity, like we just showed you, is shown on the charts by huge blip upwards on volumes, and that is something you must see very, very carefully, because that indicates what the big boys are doing on those stocks and what their views are on those stocks. All right. So we figured out volumes on these charts. We've looked at areas where you have huge amounts of bars which are showing up volume. That means good news for the bulls. Huge amount of volume cluster where you are seeing a lot of down moves. That's good news for the bears, and that's what you need to look at. On that note, it's time to take a small break, but here's a quiz question for you. An oversold market, what is that? Is that a market that has A, too many sellers, B, potential to go down, C, potential to go up? Think which is the right answer. We'll tell you when we come back.